Hello, I'm Joseph Graff. This video is one part of a 500-part video series where I analyze the 500 largest companies in America. If you'd like to check out my other videos where I conduct stock analysis on other companies, I will include the link in the description. Also, I'd like to say that if you enjoyed today's video, please make sure you hit the like button and subscribe to the channel. Also, hit the notification bell so you'll be notified whenever I post future updates. Lastly, I'd also like to talk about M1 Finance. M1 Finance is running a great promotion right now where if you sign up using my referral link, we both receive $10 that we can use to invest in the stock market. I'll include my referral link below. Thank you all for watching, and here's the video. Amazon was founded in 1994 by Jeff Bezos. They specialize in e-commerce, cloud computing, digital content, as well as artificial intelligence. You all probably best know Amazon for its online web catalog, Amazon.com. Amazon offers a wide range of products for sale on their site and has gained popularity in recent years due to its new 2-day shipping that it offers to Prime members, which is a premium subscription service that gives subscribers discounts and fast shipping on a wide range of products. Amazon's operating segments include online stores, physical stores, third-party seller services, subscription services such as Amazon Music, and also Amazon Web Services. In 2019, Amazon's largest segment was their online stores division, which netted them $141 billion in revenue. Amazon Web Services has been growing the fastest for the company, as they had a 37% increase in revenue between 2018 and 2019. Amazon is currently the third largest company in America, sitting behind only Apple and Microsoft. At the time that this video was recorded, Amazon's market cap was $1.19 trillion. In this next slide, I will be talking about earnings and earnings growth. These two metrics are important because they are the driving force behind a company's valuation and thus the company's stock price. Companies usually report their earnings every quarter. Large, stable companies tend to have positive earnings, while companies with high growth potential may operate at a loss in the hopes that they will become profitable in the future. Understanding a company's earnings and earnings growth goes a long way in being able to accurately value a company. In 2014, Amazon actually lost money, losing 52 cents per share. They then turned positive in the following year, earning $1.25 per share in 2015. In 2016, their earnings jumped again, this time all the way up to $4.90 per share. This was a growth year over year of 292%. Their earnings in 2017 increased to $6.15 per share, which was a 26% increase from the previous year. In 2018, these earnings jumped all the way to $20.14 per share, which was a 227% growth from the previous year. In 2019, Amazon's earnings per share were $23.01. This was a 14% increase from 2018. Overall, this indicates that Amazon has grown extremely fast at a rate of an average of 77% per year since 2014. Now that we've looked at the company's earnings, we will now talk about its price to earnings ratio, also known as PE ratio. PE ratio is calculated by dividing a company's price per share by its past year's earnings per share. Generally, companies with low PE ratios are considered value stocks, while companies with higher PE ratios are considered growth stocks. PE ratio is a useful metric for understanding how Wall Street feels about a stock. In general, a stock with a PE ratio under 15 means investors are somewhat pessimistic about a company's future, while a PE ratio above 30 indicates that investors are optimistic about the company's future. As of April 16th of 2020, Amazon was trading at $2,396 per share. This represents a trailing 12-month price to earnings ratio of 104. This is way higher than the trailing 12-month PE ratio of the Standard & Poor's 500, which at the time of this recording was 22. Amazon has one of the highest PE ratios for profitable companies in the Standard & Poor's 500. In this next slide, I will be talking about the company's price to earnings growth ratio, also known as PEG ratio. This ratio is calculated by taking a company's PE ratio and dividing it by the company's growth rate in terms of a percentage. It is generally thought that companies with a PEG equal to or around 1 are fairly valued. Companies with a PEG above 1 may be overvalued, while companies with a PEG ratio below 1 may be undervalued. PEG is a popular metric among many investors because it takes both a company's earnings as well as earnings growth into account. As of April 16th of 2020, Amazon was trading at $2,396 per share. This represents a trailing 12-month price to earnings growth ratio of about 7.5. This metric indicates that Amazon could be overvalued if you use this metric, as this number is significantly greater than 1. However, I would caution against using this metric alone to evaluate a stock like Amazon because it has just grown so fast in the past 5 years or so. I mentioned in a previous slide that Amazon has grown their earnings at an average of 77% per year over the past 5 years. This is an extremely high growth rate, which is why I don't recommend using price to earnings growth as the sole metric to evaluate Amazon stock. In this next slide, we will go over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are generally a sign of a healthy, profitable, mature company. It does, however, indicate that the company feels it has limited growth prospects, as the company is choosing to pay cash to shareholders rather than reinvesting it into growth opportunities. Dividend growth rate is the rate that a company grows its dividend payments year over year. A high dividend growth rate is usually seen as a positive to investors. Dividend payout ratio is another important metric. It represents the percentage of a company's profits that it pays out as dividends. A payout ratio below 60% usually indicates that the company's dividend is safe and has room to grow in the future. A payout ratio above 100% means the company will almost certainly cut its dividend, as that means that the company is paying out more in dividends than it is earning. Amazon currently does not pay a dividend, as they choose to reinvest the money that they receive into growing their company. Considering that Amazon is the third largest company in the world, I think that their growth opportunities will begin to slow in coming years, and there is a high possibility that they could begin paying a dividend in the next 5 to 10 years. Amazon's earnings growth was increasing at an average of 77% per year over the past 5 years. However, in the past year or two, their earnings growth has begun to flatten out. This is why I think that there is a chance that Amazon will begin paying a dividend here in the future. In this next slide, we will be going over the company's price to book ratio as well as its debt to equity ratio. The book value of a company is essentially the value of all of its assets. Book value per share is simply the book value divided by the number of outstanding shares. Furthermore, the company's price to book is just its price per share divided by its book value per share. This metric can help you understand if a stock may be undervalued or overvalued. A company's debt to equity ratio is calculated by taking the sum of all of its debts or liabilities and dividing it by the total shareholder equity. In general, companies with a lower debt to equity ratio are better equipped to withstand an economic downturn. Debt, however, can be used by companies to grow and expand, which is why a high debt to equity ratio is not necessarily a bad thing. As of the beginning of the year in 2020, Amazon had a book value per share of $124.62. This represents a price to book ratio of 19.22. This is a pretty high price to book ratio, and it's probably so high because people expect Amazon to continue to grow in the future. As of January 2020, Amazon had a debt-to-equity ratio of 0.38, which is a little more on the lower end for companies in the Standard & Poor's 500. In the next slide, we will look at the company's 3-year, 5-year, and 10-year return. A company's past performance does not predict its future performance. However, it does allow you to see how a company has done in recent years. In general, a steadily increasing stock price indicates a company has been operating successfully. If you would have bought Amazon stock on April 5th of 2017 and held it for 3 years, you would have seen an annual average return of 29%. If you had bought it on April 5th of 2015 and held it for 5 years, you would have seen an average annual return of 40%. And if you had bought Amazon stock on April 5th of 2010 and held it for 10 years, you would have seen an average annual return of 31%. In this next slide, I give my grades for this stock. I'll include grades for how I feel this stock is as a defensive investment, a growth investment, as well as an overall investment. My defensive grade takes into account how well I think the company would do in an economic downturn. My growth grade for the company takes into account how much I expect the stock to grow in future years. Finally, my overall grade is my personal opinion on the stock and whether I feel it is a buy or a sell. Keep in mind that these are my own opinions, and I am not recommending you purchase this stock or make any investment without doing your own research. As a defensive investment, I gave Amazon stock a B. Overall, I think Amazon would do fine during a recession, but what kind of scares me about Amazon is how high their PE ratio is. A PE ratio of 104 is extremely high, and it indicates that a lot of growth is expected here in the future. If something was to go wrong and Amazon had to cut their earnings forecasts, that could send the stock price dropping quickly. I think Amazon stock is likely to hold its value over the next few years, but that is something that investors should take into account when considering whether to buy Amazon stock or not. As a growth investment, I gave Amazon a B+. Even though they're the 3rd largest company in the world, I do think that they have a lot of opportunities, mainly in their web services and subscription services division. Overall, I gave Amazon a B+. I think it's a good stock, and about the only thing that bothers me a little bit is how high their valuation is, how high Amazon's PE ratio is. That'll wrap up today's video. If you enjoyed the video, please make sure you hit the like button down below and subscribe to the channel. I'll be doing this type of video for every stock in the Standard & Poor's 500, so keep your eye out for future videos. Thanks again for watching and take care.